Hello and welcome to the Capital Market Bridge Show. My name is William Evans, and of course, the show scales the heights to bring you conversations that matter to you. Now, in this episode, we are going to be looking at bonds, we are going to be looking at unit trusts, but also fixed deposits. Where among the three should we invest? How much in terms of return do they give us? Should we actually make the decision to invest in any of these? Of course, to have this conversation with me is Mr. Darius Mukiza, who works with BK Capital. We've always had conversations, of course, finance, saving, capital market. How should we raise capital using the capital market? But then our viewers have always given us questions. They've always given us reviews. And this time around, they were pointing at knowing exactly how these work. How do bonds work? How do unity trusts work? But also, how do fixed deposits work for people that are willing to begin their savings or even their investments? Where should they go? Where is the big deal? And that is the conversation you want us to have. Let's begin by understanding what these actually mean in simple terms.
Okay. In simple terms, I'll begin with fixed deposits. So fixed deposits is lending to the bank now. So when you have money, let's say you're not using for a period, you can go to the bank and say, I have this money. I want to give it to you. What rate will you give me? How will you reward me for giving you this money for this period? Now, when you give the money to the bank in such terms, you call it a fixed deposit. The bank accepts your money. You negotiate actually on the rate, depending on how much you have, the relationship you have with this bank or microfinance or whatever financial institution that allows their taking deposits. And then when you agree on the rate, they take your money and they will give you or reward you with an interest. So we call that a fixed deposit. It's fixed for a certain period and they will reward you with an interest. So normally, traditionally, like when you have money on a current account, because the current account you're transacting on it periodically, they would move money from your current account into an account you can call fixed account. So depending on the banking system or the software or whatever they use, they move money from, now it's not available for use, and they lock it into an account in your name, and you cannot touch it for that period you agreed. So when the period expires, the money is now released to your current account. Now you can use it, and they normally do that with the interest that you agreed on. So normally for the fixed deposits, money, the locked money and the interest, they pay you at the end of that period. It's paid once everything has matured. Money and interest is released to your account. Now the current account, which is now makes the money available for your use. For the bonds again, I'll use in simple terms, is lending to the government or an institution. So the bonds issued by the central bank, we call them treasury bonds. This is money the government borrows from the public through the central bank. And they are issued, they are issued with different terms. It can be a bond of 5 years, 10 years, 15 years, 20 years. And when the government needs money, they issue those bonds. And people now lend to the government, and they pay normally every 6 months. So a bond can be, say, a bond of 5 years can be at 10%. They say we'll give you 10% every year of your money, and they normally pay that 10% twice in a year, half, 5% every 6 months. So that is what we call a bond. It's the same principle even corporations use. They need money, they want to raise capital, they borrow from the public. Now we call that a corporate bond. The third one, the unit trust, the one you asked, is also a way. It is a fund managers pool money from the investors into a pool, and it's invested. And these people who have invested or who have bought units, now they are called units. Like that money is portioned into units, and now if you put money into that trust, you buy units into that pool. The money is invested by the fund manager, and once that money earns interest, it is distributed to the unit holders. So that is called a unit trust. So unit trusts can also be different. They can pay interest depending on the performance of the fund manager. For them, they don't guarantee interest. It depends on how the investment manager is able to invest that money. So normally, when they are setting up that trust, they say money we pool will be investing it in these instruments or in these assets. And depending on how the manager is able to move money from, depending on which assets are earning, whatever money is earned is the money which is distributed to the unit holders. Yeah. So the difference between these is that bonds and term deposits, for them, you already know the interest. We call it fixed income. You know it is going to earn me this money in this period. For unit trusts, it depends on the performance of the trust, of the manager. If the manager is very experienced, knows his trade, is able to invest very well, earn good interest, and you can get the interest depending on the performance of that trust. Yes.
But let's get to the context of Rwanda. You've been in the market. I know you have very extensive knowledge about Aguka Fund and how these unit trusts work. What should these three mean for an ordinary citizen? I'm looking at all classes of people.
All the three are available, and it normally depends on the goal of the investor. So all these options help you first to preserve your capital, because all of them have that element of capital preservation. But now the goals differ. People have different goals. Normally, let's say if you're building small capital, if you're building capital, a unit trust is the best option. If you have capital now, you want to commit into one asset class for maybe 4 or 5 years, a bond helps you. If you want to now have capital for short term, you have funds for short term which you're not going to use, you can now do maybe a term deposit. So it depends on what a person's goal is, but all these instruments are available. Let's say in Rwanda, we have Aguka Unit Trust, which is our very own unit trust fund, and the government bonds. When you go to the central bank's website, you can see there is a calendar. The calendar helps you to know when the bonds are going to be issued. Now you can plan. Say, I'll buy a bond, and I can buy for this amount. Even because regardless of the calendar, you can always buy these instruments any day. When the bond is issued after 2 weeks, it's normally registered on the stock exchange. So you can go to the broker and say, I want to buy this bond, please help me. And we have the brokers, licensed brokers in the market. You can even come to BK Capital and we're able to assist you to do that. Unit trusts, they are open-ended. Open-ended means you can buy it at any time. You can just, even in day, if you have money right now, you can send money like multiple times into a unit trust. For them, they're open-ended. You can enter and exit at the same time. Anytime, sorry. For them, there are no restrictions. Even term deposit, banks always will come in to say, I have this money, put it for me for 3 months, for you negotiate on the rate, and they're able to do for you that. So it's a good way. It's all about someone having the goal, and then these instruments can really help you achieve that goal.
Let's take an example of someone that is probably earning 300,000. From where you see it, of course, this is going to be free financial advice. But what sort of advice would you give them? Where should they begin from? Because yes, we appreciate these are available, but they may not be favoring everyone, definitely, in terms of how much you earn, but also how much you've been able to solicit or even to save as an individual. For someone that is having a base salary of, let's say, 300, what is the best place to begin from?
Yeah, well, all these instruments, like the bonds, the minimum amount is 100,000 to buy a bond, minimum 100K. Term deposits, depending on the bank you use, banks are always willing to assist you to do a term deposit. From, I think, even 100,000, you can do a term, you can fix your money. Unit trusts, like for Aguka, you begin with 10,000. To have the beginning, you open an account with 10,000, but you can always send as long as 2,000, depending on any time. So there is no a lot of money. Normally, when I say this, there is no money which is a lot of money. If I ask you how much is a lot of money, any amount is can help you to reach a goal. You see, if you save 1,000 today, you've started. That is the first step. Tomorrow, your 1,000 won't be 1,000. It has earned interest. So basically, it's not about how much someone is earning, it's how much someone is able to save. Yes. So you can, and having the goal really, because like I said, all these options are available for you. For the bond, 100,000, you can begin. For unit trust, 2,000. For term deposits, depending on the bank, but even I think from 100,000, you can begin to do your term deposits. And there are all these instruments, bonds, unit trust, you find there is no fees for saving through a unit trust. There are normally there are no fees to save. There are no fees to exit. So basically, every amount is welcome. So you don't need to, when you're beginning to save or to invest, it's not about how much you have. It's how much you're really able to commit, and with discipline or with determination, because most of the time people have intentions. It's not about even intentions plus actions is what really guides, and goals is what really is the key. So if you go to the fund manager, you can say, I have 100,000. I want to achieve this goal. Help me. Maybe you can do a term depot. You can do a standing order, for example, from your account, and then it's done automatically. Money goes to your unit trust on monthly basis or weekly basis, depending on how frequent this amount reaches your account. So it's any amount you can begin with these instruments, term deposits and unit trust. For the bonds, you need 100,000 to start.
Where's the deal in the three?
Yeah, so let me explain this very well. So with the bank, when you do a term deposit on these three, the bank gives you the rate. You negotiate depending on the amount you have and maybe the relationship you have with this bank. You're able to negotiate and you get that rate, and you know this is the rate I'll get. Normally, the banks are flexible depending on their clients, and they can tell you we'll give you this interest, so you know that. For the unit trust, it depends on how the fund manager has performed. So for most of the time, like for the bonds, right now you can go and look at the what we call a yield curve. It's like a guiding principle it helps you to gauge. Say, right now these bonds are on this year, the bond is at this amount. So that gives you an indication to say, okay, if the bond is the 1 year bond is at maybe 11%, maybe unit trust, how much is it? So now you can gauge, and now you go to the bank, say, well, how much can you give me for a year? So you're able to say, now this is offering better return, and when you match that with your goal, it helps you now to at least put it into practice. So, but still you can see what the fund manager is aiming at, and then you can go look at the yield curve for the central bank, and you gauge this coming bond is probably within this range. So it helps you even when you're an investor at least to get that information. It's free of charge. It's available information, and it's published, and you can easily get access to it.
Thank you, Darius, for always sharing your insights. Our part is to bring you conversations that matter. Your part is to tell us what conversations you want to hear from the Capital Market Bridge Show. My name is William Evans. See you next time. Goodbye.